Good morning, everyone, and welcome to The Morning Bell. I'm Robert, and joining me, as always, are Lizzie and Steve. It's Tuesday, February the 10th, 2026, and we've got quite a bit to unpack today. Markets are showing some interesting dynamics, and there's a lot happening beneath the surface. Lizzie, let's start with what's catching your attention in the news this morning. We're seeing some notable corporate developments and what looks like a shift in market leadership.
Thanks, Robert. Yeah, there are a few key themes emerging that traders need to watch closely. First, we're seeing a clear divergence in the market, with healthcare propping up employment numbers, which is actually a concerning signal when you dig into it. The Wall Street Journal is highlighting this, and it suggests the broader labour market is weaker than headline numbers indicate. On the corporate front, we had some disappointing earnings from consumer-facing companies. Coca-Cola shares dropped 3% after forecasting modest growth amid demand concerns. They actually missed on sales despite volumes and prices both rising, which tells you something about the underlying consumer weakness. CVS did better, topping estimates and reaffirming guidance as their turnaround takes effect. But even their stock fell 3% on concerns about Medicare business changes. What's really interesting is the energy sector, Robert. BP became the first oil major to suspend its share buyback plan, which is a significant signal about cash flow concerns in the sector.
That's a solid observation about BP. It does suggest they're being more conservative about capital allocation, which could indicate they're expecting lower oil prices or want to preserve flexibility. What about the technology sector? I noticed there was some news about Taiwan pushing back on Washington's chip supply goals.
Exactly, and that's a geopolitical risk that's not getting enough attention. Taiwan called it impossible to meet Washington's goal of relocating 40% of chip supply. This has implications for companies across the semiconductor supply chain. We also saw Tesla lose another executive, Raj Jagannathan, after 13 years, which adds to concerns about talent retention there. But here's something that caught my eye for the bond market. Alphabet just issued a landmark 100-year bond in the UK that received the highest demand in a sterling sale. That's notable because it shows investors are willing to lock in rates for a century with a tech company, which tells you something about confidence in both Alphabet's longevity and the current rate environment. The other big theme is this jobless growth era we might be entering. Bloomberg is calling it out explicitly, and if healthcare is the only sector adding jobs while other sectors stagnate, that's going to weigh on consumer spending and corporate earnings going forward.
That's a really important point about the structural employment shift. It reminds me of previous cycles where one sector masked broader weakness until it couldn't anymore. The Alphabet bond is fascinating too, especially at a time when we're seeing such volatility in equity markets. Steve, let's turn to the economic calendar. We don't have much on the schedule today, but what's coming up later this week that we should be watching?
That's right, Robert. Today is relatively quiet on the economic data front, with no major indicators scheduled for release, which gives markets a bit of breathing room after recent volatility. But things pick up significantly starting tomorrow. On Wednesday, February 11th, we get the non-farm payrolls report, which is always a major market mover. The forecast is calling for 70,000 jobs added, which would be an improvement from the 50,000 we saw in the last release back in January. That January number actually came in below the 60,000 forecast and was down from the previous month's 56,000. So we've seen this deceleration in job growth that Lizzie was just talking about. This will be critical for understanding whether that healthcare-driven employment trend continues or if we see broader strength. Then on Thursday, February 12th, we have initial jobless claims, which will give us a real-time read on layoffs and labor market conditions. Also on Thursday, we get existing home sales data, and the forecast there is 4.15 million, which would actually be a decline from the 4.35 million we saw in January. That January number was stronger than expected at 4.21 million forecast, and it was up from December's 4.14 million, so we had seen some momentum in housing. A decline back to 4.15 would suggest that momentum is fading, possibly due to mortgage rates staying elevated. Finally, on Friday the 13th, we get the Consumer Price Index, the CPI report, which is obviously crucial for Fed policy expectations. The forecast is for 325.41, up from 324.05 in the previous reading. That would represent continued inflation pressure, and any upside surprise there could really shake up rate cut expectations for the rest of the year.
Thanks, Steve. So we've got employment data, housing, and inflation all hitting within the next few days. That's a pretty dense calendar that could really set the tone for the rest of February. Lizzie, let's shift to our stock of the day. We're looking at Palantir Technologies, ticker PLTR. This has been one of the more controversial names in the market. What's your take on where things stand right now?
Palantir is a perfect example of a stock where the fundamentals are exceptional, but the valuation has become a real problem. Let me walk through this because it's important for traders to understand both sides. The stock is currently at 142.91, which is down about 14.9% year to date and about 31% off its 52-week high of 207.52. Now here's where it gets interesting. The company just reported fourth quarter 2024 earnings on February 2nd. And they absolutely crushed it. Management is guiding for 61% revenue growth in 2026, which is 15% above what analysts were expecting. They achieved a Rule of 40 score of 127%, which is an all-time high and shows they're growing fast while staying profitable. Their free cash flow was $2.1 billion over the last 12 months, and projections have that reaching $11.3 billion by 2030. So operationally, this company is firing on all cylinders. They're positioned right at the intersection of AI and enterprise data analytics with their Gotham platform for government and Foundry for commercial clients.
Those are impressive growth numbers, but I'm sensing there's a significant but coming here. What's the concern?
The concern is valuation, Robert, and it's a big one. The stock is trading at a price-to-earnings ratio of 226.84. Even the forward PE is 78.68, which is still extremely elevated. The price-to-book is 46.17. Simply Wall Street gives it a 0 out of 6 score on valuation checks, which is basically flashing red across the board. Here's the reality. At 227 times earnings, this stock is priced for absolute perfection. Any stumble, any quarter where they don't deliver on these massive growth expectations, and you could see severe multiple compression. The analyst consensus target is 189.92, which implies about 33% upside from here. And the recommendation is buy from 24 analysts. But that year-to-date decline of almost 15% tells you the market is already starting to reprice this stock. Institutional investors like Ken Griffin and Cliff Asness accumulated positions in Q3, which validates the long-term thesis, but they likely got in at much better prices.
So for someone looking at Palantir today, what's the actionable insight? Is this a buy-the-dip opportunity, or should investors wait for a better entry point?
I'd say this is a buy-the-dip stock, not a buy-at-any-price stock. If you're already holding it, you need to weigh that 33% upside to analyst targets against the risk of further multiple compression. The operational story is intact. The AI thesis is real, and they have limited direct competition in their specific niche. But if you're looking to initiate a position, I'd wait for a better entry. A pullback to the 110 to 120 range, which would put the forward PE around 55 to 60 times, would offer much better risk-reward. The company needs to consistently deliver 50% plus revenue growth for several quarters to grow into this valuation. The risks include competition from Microsoft, Google, and Amazon, expanding their AI analytics offerings, concentration in government contracts, which can be cyclical, and just general market sentiment around high multiple tech stocks. The key catalysts to watch are the quarterly earnings reports, new major commercial contract announcements, and whether they can sustain these margins at current growth rates. This is definitely high risk, high reward territory.
That's a really balanced assessment. It sounds like the company is executing well, but the valuation leaves very little margin for error. All right, let's move to crypto. Lizzie, what are you seeing in the digital asset markets? Bitcoin has been pretty volatile lately.
Crypto markets are showing some stress right now, Robert. And the sentiment is decidedly bearish across the board. Let's start with Bitcoin. It's currently circling around $70,000 after rebounding from a drop to $60,000. But that rebound has hit resistance at $71,000. Sentiment is at its most fearful level since 2022, and searches for Bitcoin capitulation have risen significantly, which tells you retail is getting nervous. The interesting thing is we are seeing some positive signs mixed in with the fear. Bitcoin ETFs just had back-to-back inflows for the first time in a month, with $145 million in fresh inflows hitting the market. That suggests institutional investors see value at these levels. Bernstein came out and called this sell-off the weakest bear case on record and kept their $150,000 2026 target, which is pretty bullish. But here's the concern. Bitcoin miners have been selling heavily. Kango just sold $305 million worth of Bitcoin to reduce leverage and fund an AI pivot, and mining difficulty dropped by the most since 2021, which indicates miner capitulation. The Coinbase premium also saw its first green spike in a month, which means US demand is starting to flicker back. But it's still early. For next week, I'd say Bitcoin is neutral to bearish. It's likely to trade in a range as the market tries to figure out if 60,000 was truly the bottom or if there's more downside ahead.
What about Ethereum and Solana? Are they following Bitcoin's lead or showing different patterns?
Ethereum is in a similar boat, honestly. It tapped 2.1k recently as markets rebounded, but analysts are actively debating whether Ether has capitulated or has further to fall. There are some positive developments. The Ethereum Foundation is teaming up with Seal to combat wallet drainers, which addresses security concerns, and MegaETH just debuted its mainnet, which is heating up the scaling debate. Bitmine Immersion, which is Tom Lee's firm, added 40,613 Ether during the sell-off, which shows some institutional players see value. But the overall sentiment remains cautious, and I'd call it neutral to bearish for next week as well. Ethereum will likely trade in a range while the market assesses these technical developments and waits for clearer macro signals. Now, Solana is where things get more concerning. Solana treasuries are sitting on over $1.5 billion in paper losses, which is substantial. Analysts have identified what they're calling a textbook bear pattern in the charts, and some are asking if Solana is headed to $50. The combination of those paper losses and the technical setup suggests Solana is likely to continue its downward trajectory in the near term, so I'd call that one bearish for next week.
So across the crypto space, we're seeing fear dominate, but there are some signs that institutional money is starting to see value at these lower levels. That's often how bottoms form, though it can take time to play out. The key seems to be watching those ETF flows and whether Bitcoin can break through that 71,000 resistance level. All right, let's wrap things up. We've covered a lot of ground today, from the concerning employment trends masked by healthcare hiring to Palantir's valuation challenges despite strong execution to the fearful sentiment in crypto markets with some institutional buying emerging. The economic calendar is going to be crucial this week, with jobs data tomorrow, housing on Thursday, and inflation on Friday. Those reports could really set the direction for markets heading into the second half of February. As always, we appreciate you joining us on the Morning Bell. Remember, do your own research and consult with financial advisors before making investment decisions. I'm Robert, and we'll see you next time.